Welcome to the Commercial Credit Corner podcast with your hosts, Qualtik CEO Mark Pryor and Qualtik's President Mike Fletcher, here to give you commercial lending and credit insights to help community bankers manage their loan portfolios in an ever-changing economic landscape. Based out of the Qualtik offices in the beautiful Portland, Oregon, we look forward to diving into current events with some exclusive insights from experts in the industry.
We're excited about today's podcast where we had a conversation with the Wolf & Company about trends in the commercial real estate space, the way that CFOs are thinking about reserves, and the general concepts that chief credit officers are facing today related to the evaluation of their portfolios. Before we dive into that, let's hit our news section. And the news section today, we had some interesting contrast between two articles that came out within a couple of days of each other here, Mark. The first one was from the Harvard Business Review, and the title was U.S. Commercial Real Estate is Headed Toward a Crisis. That was their headline. And then within a couple of days, you've got the New York Times that comes out and says, real estate crisis, small banks say their loans are fine. So you've got these two very contrasting articles, and I thought it would be fun for us to just talk about some of the things that they call out in these articles, and why is it that you can have headlines that are so dramatically different from each other. Curious of just your general kind of overall take from reviewing those two articles.
Yeah. So, you read one, you're depressed, you read one, you're not. And the takeaways, there are similar takeaways. There are some overlays in the two articles, but the thesis of the Harvard article is that big resets are coming, occupancy is too low, interest rates are killing portfolios, and it's going to drag, and it qualifies it a lot, by the way. It could drag the entire economy into a recession. Whereas the New York Times article takes the very opposite approach and both are data driven. I do think it's interesting, a couple of things. The first is who wrote this at Harvard. It's an academic. It's someone without industry, without having not operated the industry, and it's not her area of subject expertise, but she does understand finance. The New York Times article was written by their head of their banking and finance desk at the New York Times. So it's pretty well researched. And the other thing I really think, as you look at these two articles, is that it focuses both on community banking and the outsized role community banking has in overall lending. But my big takeaway, and I think you and I discussed this before relative to that, is that big banks have the largest exposure to CRE because they're the ones with $150 million loans to large commercial spaces in Manhattan, and community banks generally have much less exposure because they just don't lend at those levels. And if you'd written the Harvard article 3 years ago, it would have said the exact same thing it says today, with the caveat that interest rates weren't super high. I'm interested to get your take on that. That's some of the thoughts I have on it. I'm interested to get your take on the two articles as well, and the contrast particularly.
Yeah, let's dive into some of the logic, some of the stats behind the argument or the position that each of these articles take. So one of the first things that stood out to me has to do with the way that certain ratios are being interpreted. And you just hit on a piece of this, is where are the concentrations for these banks? So there are a lot of community banks that have little to no office loans in their portfolio. So that's one thing to know and to understand. But let's dive into one of the particular sections of this article from Harvard. They say that they're speaking of the high ratios. They say CRE loan values are far exceeding risk-based capital levels at 158 and 228 respectively. So 228% of risk-based capital, according to the Conference Board calculations using FDIC institutional financial reports data. And it then compares this to 142% for large banks that have assets between 10 billion and 250 billion, and then 56% for the largest banks, assets greater than 250 billion. So just to give a little additional context here, you have this ratio where from a regulatory perspective, that 300% is often the number that's referenced in this industry, where you say, hey, if you're creeping up over 300%, you're going to need to be able to justify why you have a ratio that's that high.
Yeah, it's a different regulatory threshold over 300% that has been pretty steadfast for a while. That's been the threshold number post-crisis for banks.
Yeah, but one of the things that I think is really important to understand is that just because you have a high ratio does not mean you have a lot of risk in your portfolio.
Agreed.
There's more to look at here than just simply what your ratio is. So for example, if your loan to value is low, so you have a bunch of, let's call them $5 million loans where are on $10 million collateral. So you've only got $5 million out as a bank that you've lent, and the collateral's worth $10 million. You're at a 50% LTV. Your position there is significantly different than if it's $8 million out on a $10 million piece of collateral. And so the LTV is going to be a major factor in how much risk you have here. And then another major factor is the concentrations themselves. How concentrated is the bank in any particular area? So office is the thing that gets a whole lot of attention in these two articles, and in the market in general. There's a whole lot of discussion about office because you've got the occupancy challenges with all of these shifts. But there's more to it than just looking at these ratios. You can't just point at a ratio. And the New York Times points this out as well, where one of the banks that they were interviewing had over a 400% ratio, but they said, hey, we're not concerned about our risk at all because here's where these loans are and here's what our LTV looks like. So that was one of the first things that stood out to me.
It stands out to me as well that it's more that risk-based capital number. That's part of the story, but there's a much deeper underlying story that I still feel pretty good about at the community bank level. I think, at least for me, as I contrast the two articles, I tended to go where the New York Times was going with that, is that to exactly your point, Mike, that number doesn't tell the whole story.
Yeah. So the second thing that stood out to me as far as analyzing these numbers, the Harvard article references the portion of these loans that are non-performing more than doubled from 0.54 to 1.25. And doubling sounds terrible. But within the context of the industry, 125 is not a super scary number if you just took a look at that by itself.
No, and considering what's happened relative to interest rates and occupancy, we've been for the last 10 years in historically low interest rate environment. Money was essentially not free, but close to free. Lots of money being lent out, and considering how rapidly it dried up and what's going on in CRE, that's not bad at all. That's not a scary number. Right. Also considering we've been in this cycle about 3 years now, starting with the 4 years, starting with the pandemic and extending into higher interest rates.
And I guess that's the next really big question here is, where are we in this cycle? Yeah. So are we at the very beginning? Because one of the other things that the Harvard article points out is they were comparing that 1.25% of the non-performing to 0.87% of 6 quarters leading up into 2006. Now, if we're before the beginning of a recession, if we're before the beginning of challenges in the industry, then you would look at those two numbers and say, wow, we're in a much worse position than in 2006. But if we look back at 2006, 2007, 2006, everything was just run and gun. Everybody was making loans. Everybody thought the market was going crazy. That you weren't in this position where people were saying, hey, there's risk here. we haven't been really watching this. And I know in the industry, when you look at the banking space over the last couple of years, reserve amounts have been increased substantially at these banks over the course of the last couple of years. There's been a lot of discussion about the friction that has been introduced and has been there for a while. Interest rates went up a while ago. There's these banks are actively working their loans. So I'm not going to say that it's necessarily wrong to compare that 0.87 to the 1.25 of today. But I guess the question that you've got to ask yourself is, where do you think we are in the cycle? Are we in a place where everybody is just recklessly lending money and thinks that the world could never be rough, or are we in a spot where everybody's contracting? I guess that's one of the things you've got.
One thing that struck me is in 2006, there was zero pullback in credit. There was, like you said, people were still running and gunning at that rate. There has been a significant pullback in credit over the last 2 years. It just is not, because where interest rates are and because of the concerns in CRE, it's already baked in. There's a lot less money being lent, and that wasn't the case in 2006. The other interesting thing is it wasn't commercial real estate driven in the last cycle. It was residential driven. Residential lending is what ate up the market, the securitization. We could go into a whole nother segment on that, but particularly securitization and loans being made that shouldn't have been made in resi space was what toppled the last. Commercial did not take a huge hit in the last cycle relative to residential, nowhere near what residential took. My gut is that we're already in the cycle based on this information, that because lending is already retracted, because there's been a lot of eyes on this since the pandemic, with interest rates are where they are, we are somewhere in a credit cycle that it was coming for the last 10 or 15 years. And my hope is that we're heading toward the backside of that cycle, but some things have to happen. First, interest rates have to come down. And secondly, particularly when it comes to office, occupancy is going to have to continue to go up. There have been some trends over the last 6 months where occupancy has increased. I think that's natural. We're getting post-pandemic. We were going to see some of that. But those two things really have to happen to stabilize this commercial, particularly office market. And I think those things are starting to happen. I think the Fed sometime in the future, we've been hearing it for a year now, but they have strongly signaled in September, all things being equal, they're going to do the next rate cut. That will help stabilize this market. But, the Harvard article says could a lot. And it was taking factors, at least as you read it, it's taking sort of worst case scenario factors. It never calculated in that interest rates would go down. I read through the article twice, and I said at some point they're going to say interest rates may go down. What does that do to it? I think the New York Times article did take that into consideration, that interest rates won't stay where they are, provided inflation continues to trend down to the level that Fed wants it to trend down to.
Yeah, and the article wasn't. The headline may have been a little aggressive related to.
Well, yeah, it was aggressive. If you read that, it doesn't say could in the. It says headed to recession. Anytime you see that as an article, I mean, I hate to say that the Harvard Business Review is using clickbait, but it made me read it as soon as I saw it.
Yeah, it got our attention. Let's dive into the New York Times article a little now. They've got some interesting points. One of the things that they say is that the majority of commercial building loans by community banks are for smaller buildings. So it's talking about things related to doctors' offices, local businesses, things along those lines, as opposed to a high rise. And that they tend to be fully leased, that these loans from the community banks tend to be fully leased in loans for doctors' offices and the like. So it really does get back to that concentration conversation. Where are the loans being made? Every bank is unique as it relates to their concentrations. And this is one of those areas where the bank needs to understand it, and the regulators are really pressing on that. It's definitely one of the things that we see is there's a lot more conversation about, do you understand all of the different perspectives from a concentration perspective? So are you looking at the geography? Are you looking at who the borrowers are? Are you looking at the industry that you're in and all of those different things? Because concentration can mean a lot of different things. So that was one of the points that they made that I'm curious to hear any other thoughts you have on that one.
Yeah, their approach was really focused on what is driving some of the pain in the marketplace and who has the most exposure. And at least as I read the conclusion, it was that the community banks are not as exposed as large banks, and community banks are working far more proactively with borrowers than larger banks are. And they're concentrated in a different way. They did poll a fair number of community bank board members and CEOs for the New York Times article. And I get that there's probably some hubris that aren't going to come out and say, "Oh, good gosh, the sky is falling." But there were some through threads with it. One is this withdrawal of credit. They withdrew credit relatively early in these cycles. They began to proactively work loans in ways that they previously had not. And so the idea that extend and pretend, while it probably exists to some degree to the level that it existed in 2006, 7, and 8, it nowhere. Maybe the lesson from that era is if you feel like there's pressure in a credit cycle, because don't forget, we had a full positive credit cycle roughly from 2012 until the beginning of the pandemic, middle of the pandemic. That's a long cycle to be lending, and so this is some natural contraction. The thesis of the article, and I tend to agree with it, is that banks, community banks in particular, are highly proactive and not nearly as exposed as very large banks are.
Yeah. From a numbers standpoint, one of the examples they put out there, Flushing Bank was a bank that they interviewed, and Flushing Bank has 4% of their total portfolio in office. 38% is in apartments. So you've got one example. It's anecdotal, but to go back to our earlier point, you can't just look at a single ratio and say this bank is at risk or not a factor. So one of the other points in that New York Times article is that there's 400 banks that are $15 billion in asset size or smaller that have over a 300% ratio.
Yes.
First of all, I want to point out there are thousands of banks in that category of 15 billion or smaller. So that's one thing to know. And also, just because you're over 300% does not mean you're more at risk. You can have a very low ratio, but if you're overly concentrated or you've got a couple of big loans that are going bad, you can be in much worse shape than a bank that has a very high ratio. So there's not a straight line correlation between how high is your ratio. It's not directly going to correlate to how much risk you really have.
No, and I agree from a scorecard perspective, that 300%, while not a completely arbitrary, is a bit arbitrary. It really reinforcing what you just said. It's much more to do with the quality of the kinds of loans versus that ratio. That ratio is in place just so you need to justify if you're going to continue to concentrate in a particular area. Why are you doing it and how are you doing it? And at least in my experience, banks that are over are purposely going over and are comfortable in their credit policies and how they've went into that ratio to go over, like mentioned.
So real interesting conversation, Mark. It is fascinating to see how you can end up with different conclusions based on which ratios, which numbers you're looking at, and the complexity of this market. We'll put the links to these articles in the podcast notes, and we're going to move over to a conversation that we had with Wolf & Company. Looking forward to sharing that with people. They have some very interesting perspective around how banks are thinking about their reserves and how chief credit officers are focusing on these things that we just were talking about, how they're managing their concentrations, how they're managing their ratios, what they're looking at a more granular level to make sure that they keep their bank in a good spot. Today, we're happy to welcome two members of the Wolf & Company team, Gene Shagru, he's a senior consultant and former chief credit officer, and Andrew Billiter, he's a principal at Wolf & Company. And we're going to be discussing things related to today's economic environment and how it relates to the commercial loan risk landscape. We'll also get into how banks are thinking about resilience and managing their reserves during these times. So Gene and Andrew, welcome to the Qualtik Commercial Credit Corner. All right. So, Gene, let's get started with you. We're going to start off by asking you to put your CCO hat back on. You did that job for a long time. And I'm going to just throw a few headlines from today's news out at you. And let's talk about how you'd be thinking about it at the bank. So, according to the CME FedWatch tool, there is a 90% chance that we see a rate cut in September and 50% odds of 2 additional rate cuts by the end of the year. And there were some downward jobs revisions for April and May, but we are still seeing a 3-month average payroll gain of 177,000, which is relatively strong. How would you be thinking about the general economic environment as a CCO right now?
All right. Well, Mike, it's a pleasure to be here, and thanks for that question. So first of all, it seems like we're coming in for that coveted soft landing that I'm sure the Fed is hoping for. Go back not too long ago, and inflation was running, north of 9%. Now we're down to 3%. We just got GDP numbers for the second quarter of 2.8% growth versus economists' forecast of 2.1%. And job creation is doing okay. It's I think for last month it was actually 206,000 jobs. So with inflation running at 3%, it's more likely, as you alluded to, that we're going to see some rate cuts. It's expected to in 2024, September, then maybe later in the year. But Chairman Powell has been very clear that he's going to go slow because, if nothing else, the stronger than expected GDP growth Q2 does lend to his concept of going slow. But what I do want to say, from my line of sight, the expected rate cuts, they're going to be helpful, but it's not a silver bullet. It's not a magic potion because we still have certain dynamics that still need to be dealt with. I think the biggest thing post-COVID is the work from home impact. And the fact of the matter is that for so many office tenants and companies, their real estate needs have been almost cut in half. So you still have to deal with that dynamic, particularly on the office valuations. The value of office real estate has fallen dramatically. So in overall rental rates have fallen. So rates will help, but we still have to deal with the collateral valuation, the free cash flow to service the debt, and the occupancy level. So good news, but we still have a ways to go.
Yeah, that makes a lot of sense. Let's dive just a little bit further into that, Gene. There is a lot of news out there about vacancy rates, specifically in office, and this new work from home dynamic in this economy. In our discussions, we've talked a fair bit about how location and the class of real estate impacts the risk quite a bit. Are there other factors that are more relevant in today's market than maybe markets of the past? And you've referenced a few of them, but things that are different in today's economic environment that have you looking at it through maybe a little different lens?
Sure. So let's go back. I mean, some of the metrics are still very important, and they're traditional. Location of the real estate, the class of the real estate, and we're talking office versus let's say industrial versus multifamily. The age of the property, the sponsor of the deal, and the deal structure, recourse versus non-recourse or a special purpose entity. But let's go back to just the location and class of property. If we look at down in New York City, and I'm an East Coast guy, so if a lot of my comments tend to be East Coast, I'm sorry, but that's where I live. So down in New York City, I think the overall occupancy of a vacancy rate is somewhere around 17 or 18%, okay? Yet two-thirds of New York City's office space is Class A. Now, if you go to Class A, there's certain areas where that vacancy rate is now down to 13% versus 17 or 18. That's a big deal, and that's Class A office space that has come on the market since the year 2000. So here we have Class A versus Class A, but the newest Class A is getting the best play. So there you could say, well, I have Class A office space. I'm okay. And look, New York City, it's not like you're talking like the state of Pennsylvania. It's a very tight geographic epicenter, but where that real estate is located in the vintage of that real estate matters. But now let's go to Class A. So now you have a real strong office building in New York City, let's say, and there's a couple of examples recently in the Wall Street Journal down around Grand Central Station that you're saying, I'm okay, I'm going to be able to lease this space up, strong tenants. But right now, what we're seeing, if you want to get a new Class A tenant, on average, you have to give 1.3 to 1.5 months free rent per year in order to get that tenant in the building. And on top of it, you have to have generous tenant improvement accommodations to get that tenant to come into your space.
Before we do that, let's step over to another piece of news that's been out there for what feels like the better part of a year and a half, 2 years that people have been talking about. And it's this really well documented $600 billion in commercial real estate loans that are set to mature in 2025. We had a big number in 2024 that have been maturing as well. And so you've got all of these loans that were on maybe a 5-year as an example, maturity, but there's a big balance left, and those are going to roll over, and the bank is expected that they expected and the borrower expected that to be refinanced. But now you have this dramatically different interest rate environment. When you hear that, and you've got these other factors that we've just talked about, what comes to your mind related to these related to this set of loans that are going to mature in 2025?
Right. Well, unfortunately, I'm gonna have to harken back to a couple of common themes I already mentioned, right? So, it first, you look at the type of real estate. Are we talking multifamily? Are we talking office? Are we talking retail? Because it's interesting, a lot of our conversation so far today has talked about office, but surprisingly, retail is doing quite well, because if you think about it, what put the pressure on office was COVID versus retail. That pressure point developed earlier as we started to see the advent of internet sales versus versus the go to the shop live kind of thing. So I think the lessors of commercial real estate on retail, they've adjusted and they've worked through. And I think post-COVID, a lot of people who are inclined to shop in person want to do that again. So we see some strong metrics on the retail space right now versus the office space. The other one, of course, that we've heard quite a lot about over the last 3 to 5 years was industrial space, particularly that last mile delivery needed to get my overnight package to Amazon or the same day because I can't wait anymore for that package. Well, that class is performing much stronger than, let's say, general office space. But even that, clearly that is not performing, let's say, as poorly as office. But the bloom is off that road a little bit right now. You went back 2 years ago and it was like build it and they will come. That's not quite happening anymore. So location matters quite a bit for all of these. But going back to we talked a lot about what's taking place in your marketplace. What's are the workers coming back to work at least somewhat like we see in New York City versus not the same back to work trends in DC. That's going to have quite a bit of impact. I already touched upon the structure of the transaction. Is it a standalone, non-recourse transaction that we might see in a more urban in New York City or a Washington, D.C. marketplace versus the suburban marketplace that I just talked about, where, again, you probably have some recourse or the sponsor is standing behind the transaction versus a non-recourse transaction. But then even as I touched upon again with like the Class A space, we in New York is just so interesting where 2/3 of it is Class A, yet you have to get down into specifics because you need to know when that Class A space actually came online, because that's what the employers are trying to dangle in front of employees to get them back into the workplace, the offices. They want to show real, pleasant working environment to get people to come back and, kind of leave their bedrooms and their kitchens or wherever they've been working the last 3 years or so.
Absolutely. That closet, over on the left. Absolutely. As I'm hearing you talk, one of the things that comes to mind is that, and I see this with a lot of banks, is that it's a bit overwhelming. There's so many factors that can come up that do get asked. where do you start? Can you give us, from your perspective, the 2, 3 things? Where do you start, and how do you prioritize getting your arms around your portfolio so that you can manage this risk?
Okay. Well, it's there's know your portfolio, know your borrower. I mean, information is so critical right now. Data management, and the thing is, but you need to remain current with your information. We at Wolf and Company, we have an active loan review program that we work with our financial institution clients, and we get to look at different books of business. And haven't been a chief credit officer, and actually have been a commercial real estate lender in my former life. Sometimes we don't stay on top of our information because we say, we kind of intuitively know what's going on. Well, maybe you do and maybe you don't, but current information is so important. What's going on with your borrower, your sponsor, and what other pressure does that entity see across their various real estate holdings? What's going on in the market where my collateral is located, and then what's going on with the general economy. So data is so important, current, fresh data. And then from there, now we have good data. We start looking for concentrations in our portfolio. We want to talk about concentrations by asset class. Is it office? Is it multifamily? Because, for most real estate lenders for years and years, the perfect real estate loan was multifamily. Well, if you're a multifamily lender in New York City right now with the fixed rent program that prevails in New York City, and rates went up 300 to 400 basis points, guess what? That makes a huge difference, because the rents couldn't go up. So, there has to be pressure. So you need to understand the concentrations in your portfolio by asset class, but then by geography, because I talked about the difference in performance between New York versus Washington, D.C., and from urban versus suburban. So you need to know your concentrations. And then we talked about each market has its own dynamics. And I'll tell you right now, and I talked about, there's some interesting articles recently in the Wall Street Journal that talked about some of the financing that's taken place for some buildings in New York City, and where values differ from, let's say, some location up by Columbus Circle versus down by Grand Central Station. Huge impact. So same building, type Class A, a matter of less than a mile difference, or maybe a mile and a half, huge difference. So you need to understand the concentrations, the geographies, and then again the structure of your transactions and your sponsors. So information is key, and relevant current information is most critical.
Yeah, I think that makes a lot of sense. I want to add on there, the banks that we see that do this really well. This is a back and forth process. The notion of being able to go get all of your data current that's an elephant that you have to eat if you're going to try to do that all at one time. And the banks that we see that are on top of understanding their risk are the ones where they are going back and forth between understanding their concentrations and then focusing in on those concentrations in order to make sure that the data is all the way dialed in. And they kind of iterate back and forth between these two things, as opposed to trying to do all of one or the other. It's an ongoing process, right? Because we've got these loan reviews that are happening on such a regular basis, and the dynamic is changing. You got financials to look at on a regular basis. It's definitely an iterative process. I love it, Gene. Thank you for kind of sharing that. Again, putting that CCO hat back on. And I want to get over to Andrew now, because one of the interesting things for banks to face is that you've got this credit component. So much of what Gene is talking about is surfacing risk. It's understanding what kind of exposure, where the exposure is coming from. Within the portfolio, and what the concentrations look like. And when we get over to the financial side, and Andrew, I know you work with CFOs more than you do CEOs, right? So as you're having conversations with banks relative to managing their reserves in this economic environment, talk to us about how credit and finance kind of intersect? Where do those touch? And how are banks thinking about their reserves right now?
Yeah, happy to. Thanks, Mike. And also, I really enjoyed listening to yours and Gene's conversation. And it does play into how it actually gets into those books and records of an institution. So it is a great question. And I am going to give a little bit of a history lesson to start. We are about 18 months into everyone's favorite four-letter word, CECL, or Current Expected Credit Losses. And I'm sure you can come up with another four-letter word for it. And I'm sure that may be one of the reasons why Gene left the banking world in the first place. But I'm going to talk about it quickly just to paint the picture of what triggers there are from a credit perspective that gets over into the financial statements. As we're all aware, this did change from an incur loss model to more of that forward-looking model. And it really intended to put reserves for losses on the books at the origination date for that life of a loan. So it's not in the past, it was always looking back and you base it off of historical losses. And now you're really projecting out into the future. So this really can be accomplished using a variety of different models and methods. It can be a non-complex spreadsheet to a very complex discounted cash flow calculation assisted by a technology platform, right? So it's every institution could be doing it a little bit different, which adds to the fun for auditors, regulators, and bankers themselves. In very general terms, financial institutions really haven't seen any credit issues or experienced credit losses in a number of years. A lot of that is from COVID and the stimulus money that was pumped in. Charge-offs in general are pretty low historically in the grand scheme of things. But as you and Gene were discussing, there's a lot of potential concerns in the future that may impact capital. Heard a lot today about the office space getting back to work, the overall concentrations within certain segments and really geography. Where is your underlying properties could impact on your risk of future losses. Currently, the allowance for credit loss estimate includes a component for collectively assessed loans or pools of loans. And that's where these assets share similar risk characteristics. This is typically done at the call report classification. Mike, I'm sure you've seen that in your travels of what you're doing on a day-to-day basis. And that's what we're seeing from an auditor's perspective too. However, these pooled assets could also be based off a general ledger account, credit score, risk rating classifications or buckets, collateral type, geographical location, terms, or really any other similar risk characteristics that credit and CFO professionals can put together. Once a loan is determined not to share those similar risk characteristics of the pool, it is pulled out of the pool, and then it's individually evaluated for potential losses. When you're getting into the topic of potential losses, that's where you're also impacting your books and records in the financial statements, which really the CFO and your investors may care about. The methods for evaluating impairment under CECL is the same as the old method. Because the industry hasn't really seen any large losses in economic cycles, an institution may feel that they have risk in their portfolio that isn't in the historical numbers. Sure. And really, that's where you start looking into that forward-looking information. Projecting unemployment rates in the future. Are those going to go down? Do I have a risk of concern because it's been a high level of good unemployment numbers and they're projecting out, so I need those additional reserves, or other qualitative factors taken into the consideration? And Mike, you started to mention a few of those as we went on. Really, the qualitative considerations identified by one auditors and regulatory authorities under the new guidance are the same as the old guidance, but really the thought process has changed. The bank needs to have considerations for qualitative factors to address future risk. So it's not the old looking behind increasing 5 basis points for a reserve factor. It's why does my portfolio have more risk in the future, but it's not there in the past. And really, when you're getting into it, this may mean that concentration in geographical location that is susceptible to environmental concerns. Do we have loans in low-lying properties in Florida? Or loans in a high-risk fire area in California? Those bucketed loans may have more risk than a pool of loans that's in Omaha, Nebraska, right? Or you might have to deal with rising insurance costs or office space concentration. So all these things can be taken into account from a qualitative perspective. And really from that auditor's perspective, The financial institution will want to provide auditable, documented support for any qualitative considerations. So really, it's how are you doing these allocations of additional reserve factors and tie it to a quantitative metric. A brief example would be that if there's a risk rating deterioration in an office space concentration, the credit team may want additional reserves related to that migration. So you can look at those pooled loans or detail it even into a more deep dive into that portfolio to be like, there's a little bit of risk here. You have this concentration, as Gene was alluding to in New York. It might be in this specific zip code or area of New York or other places throughout the country, and you want to focus on that. Same thing, or if it's lending to a specific sponsor or something of that nature, where you can look at it, you can monitor it for deterioration, and you can look at it and assess it for additional qualitative reserves. A CECL really is meant to be a risk-based approach, so there are many different ways to arrive at that final reserve number, and really it's getting there, and how you document it is the name of the game.
Yeah, it's a fascinating shift, and so I want to make a comment here, and then you can tell me if you've seen similar things as it relates to the CFO side of the world. It seems as though there is more nuance in some of these conversations with auditors as it relates to the bank understanding their potential risk. And an example of that is, I want you, as an auditor, I come into the bank and I say, I want you to understand what kind of exposure you might have under these different types of conditions. And this may or may not. In fact, I'm going to go as far to say it doesn't, in some of these cases, result in a loan being downgraded. But what they do want is for the bank to at least have their arms around how much exposure they have from a capital perspective if this event were to happen in this particular concentration. So, for example, I'll just give a very specific example. Hey, let's imagine interest rates don't change for the next 3 years. What does that mean for your bank? What does that look like, and what kind of exposure would you end up having? That's the kind of question that we're seeing some of the banks we work with getting. I'm curious to hear from you, Andrew. Does that make it over to the CFO side, or does that kind of reside more on the credit side and is more theoretical?
I would say in most instances, it's probably more theoretical on the credit side. So the CFO is definitely aware of all that. They're getting data. They're looking at reports. They're taking that into consideration. From an actual preparation of the ACL reserve, and when you're getting into the estimate, when you run into issues, there could be a disconnect between the two parties, where it's most effective and it's most efficient. And what you're getting to, Mike, where you might see some of those factors and considerations getting into your qualitative review, is when you really have that chief credit officer and the credit team working with the CFO and working with accounting and finance. And it's really when you're having those conversations on a consistent basis, you might have an internal designated team that's working on your ACL reserve on a quarterly basis, including both of those entities. And they're working together. That's where you're seeing some of that forward-looking information, supporting the reserves or supporting trends within your reserves. And when it comes down to it, really finance and accounting own the model, which makes sense. And I'm saying that by meaning the CFO and accounting professionals, they really need to own the estimate, because they are the ones that have the understanding of generally accepted accounting principles, or really GAAP requirements. And they're going to know if your calculation meets the accounting standard or not. And that's what a regulator looks at. That's what an auditor looks at. But credit professionals, and you sort of already started to talk about this, they have the understanding of the underlying risk within the portfolio, including which credits at either a pooled basis or an individual basis may have weakness. They're going to know where the shortfalls are in collateral for a certain borrower, or if there's cash flow issues for a certain borrower. The CFO, they're not getting into the weeds of that. They're getting high-level reports and data to report on it. But the credit professionals are going to have that deep dive understanding of the portfolio. And really, the CFO needs to be made aware of all those insights to really be able to develop an appropriate reserve estimate. The other area that Gene touched on it when he was going into what do you really need to work on this, and what do you need to know? It really comes down to data, right? You need to have a good understanding of your data. And from this standpoint, it's usually the credit teams or the lending function that owns all the data. And usually they're working with the CFO, providing all the extracted reports that needs to get into the model. And it's really one of those things where the lending team needs to make sure that they have a good hands on the data, that they know that it's complete and accurate, and really that the finance and accounting function can rely on that data. Same being said, they're going to know the trend analysis looking forward if there is potential weaknesses that they can provide to the CFO so they can include that in the qualitative considerations. That's really how we see it, Mike.
It makes a lot of sense. And, we come back to that data piece. It's so central, being able to gather and have it be accurate, but then also to be able to analyze it, get your arms around it, being able to, in our case, visualize it. That's one of the things that we are constantly helping banks with. But I guess I've just got one other question for you, Andrew. Are there things that credit professionals can do to facilitate or just kind of make the life of the CFO's world better? Any recommendations that you have based on your travels?
I've got a few quick ones to provide to you. One of them is definitely going to be a smooth audit process, right? So that's probably the number one, is that you're going to have everything clicked in and going. A smooth regulatory process too, being able to provide information in a timely manner, one internally and externally. So when you're seeing the teams that work together well, they're getting their data and their numbers in a timely fashion. They'll be able to provide a more precise estimate. They may be able to have it more well supported based off of the direction that they're going. When you're seeing ones that may be more disconnected, is one, they're getting more pressure from regulatory agencies or auditors because the estimate is not supported. They may not know why they're doing certain things within the model or the estimate. They may not be able to speak as well. And then you can really see the disconnect in communication. But when you do have the parties working together, you would have a more precise estimate, and you would have a better overall picture of the risk in the portfolio. And that would change your strategies of where the institution may want to lend or what they want to focus on going forward too.
It makes a lot of sense. Really appreciate it. Is there anything else that either of you two want to leave us with today? I really appreciate the time.
I think we're just happy to be a part of this process and be having these conversations and look forward to working with entities like your own to continue to put out comments.
Same here.
I really appreciate the time, Gene, Andrew, coming in. I think the insights are fantastic, and we look forward to staying in touch. We've got to get you back on this podcast again sometime in the relatively near future. Really appreciate it.
Our pleasure.
Appreciate it.